Enbridge Stock, ticker symbol ENB. This stock is up a whopping 14% year to date, but still underperforming the S&P 500 big time, which is up 23%. And looking at their earnings, things look pretty interesting, with a beat on both the EPS and revenue. However, for the upcoming earnings, analysts are a bit more negative. But the main reason why people like Enbridge stock is because of the dividend. And I understand why with a dividend yield of 6.4%. The payout ratio isn't correctly displayed here, but more on that in a minute. If we look at the total returns in the past 5 years, we see that Enbridge stock underperformed the S&P 500 by a significant amount. However, most recently the stock is gaining momentum. So, could this be the perfect time to buy Enbridge stock? Well, by the end of the video I will give you my 3 price targets, so make sure to stay tuned and see how I build up to these price targets. Diving into the earnings, we see that Enbridge reported an adjusted EBITDA of 4.3 billion, an increase of about 8% year over year, which is looking pretty decent. However, the biggest segment, liquid pipelines, is nearly flat year over year, and it is the same with the second biggest segment. The growth is coming from the smaller segments here, which is great, but you want the biggest segments to grow as well, of course. The distributable cash flow per share was reported at $1.34 versus $1.37 in 2023, a small decrease. The good part is that dividends are declared at $0.67, so those are covered very easily. Another few important numbers are the credit ratings and the net debt to EBITDA. First of all, Enbridge has a A credit rating and B credit ratings, which is looking pretty good and indicating we're dealing with a decent financially strong company. The net debt to EBITDA was reported at 4.7, which is a great number, also indicating that this company is doing pretty good financially. Another important slide for me is the capital allocation priorities. Enbridge will remain focused on a strong balance sheet. And for most people, it is also very important to see that Enbridge will focus on a 60 to 70% distributable cash flow payout ratio. And Enbridge obviously really cares about the dividends, with an impressive growth track record. But it has to be said that growth is slowing down lately, so let's keep our eye on this number. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. Enbridge stock is a 89 billion market cap company. PE ratio is a little under 21, which indicates they are fairly valued right now. Later in this video I will show you my 3 price targets for Enbridge stock, so make sure to watch until the end. Revenue is at 31.5 billion, and in this graph we see that revenue went up and down a lot in the long run. Most recently it is stabilizing. The gross margin is increasing a lot over the years. In the most recent quarter it was reported at 52%. Looking at the operating margin, we see that this number is reported a little under 21%. And the good part here is that the margin is having a similar pattern. The net margin is reported a little under 13% and went down a decent amount in 2022. And most recently it is going up again. And one of the most important numbers for Enbridge is the EBITDA margin. It is also increasing a lot as we see here. To me, this is looking pretty good. The EPS is going up and down a lot as well. But for a company like Enbridge, this is very common. Analysts have mixed feelings about the coming years for the EPS. But in general, it is expected to see a decent growth, all the way up to $3. For the revenue, it is also looking pretty interesting. Analysts expect revenue to decrease quite a bit in 2024 and 2025. From there, it is expected to see an insane growth in 2027, which to me feels a bit like a fluke. Return on assets is sitting at 3%, which is a low number. Return on equity looks pretty good. And the most important number, return on invested capital, is sitting at nearly 4%, which is a low number. It is similar versus the 5-year average, which is also interesting. I prefer this number to increase over time. Current ratio is at 0.77, which is a decent number. Nothing really special to mention here, to be honest. And right now, Enbridge has 92 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Enbridge has 3.7 billion in total cash, so they can't pay down a decent amount of their debt. To me, this looks pretty bad. Potentially, this could be a red flag. So it is very important that free cash flow is growing, since this is used to pay down debt, of course, but also to buy back shares, pay dividends, and all other things. And here we see that free cash flow is going up in the long run, which is looking pretty good. But it is not really steady and consistent, so keep an eye on this number as well. Shares outstanding are increasing, which is something that I don't like. However, companies like Enbridge increase shares to raise capital and grow the business. When shares outstanding are decreasing, it increases your ownership in a company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 6.4%, which is an insane number. Annual payout is at $2.65. Payout ratio is around 50%, based on the latest earnings, and not the 130% displayed here. The 5-year growth rate is at 4%, which is a decent number. There are no consecutive years of dividend increases. In here we see that Enbridge did increase the dividends at a decent pace historically. However, in the most recent years it is not looking good. Actually, it is going down a little bit, which is quite concerning. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to increase at a decent rate from here. Overall, these dividends look really interesting to me, but how about the historical returns? I decided to compare Enbridge stock with the overall market, in this case the S&P 500. Next to that, I added EPD. On the 5-year chart we see that Enbridge underperformed the S&P 500 big time. And keep in mind, this is including dividends. EPD also underperformed the S&P 500 big time. On the 1-year chart it is getting really interesting, with ENB nearly matching the S&P 500 results. EPD is far behind with only 13% return. On the 6-month chart, it is Enbridge that is having the highest return here with 21%. EPD is again lagging behind. On the 1-month chart we see again a similar return, with Enbridge and the S&P 500. Bottom line, in the past 5 years the S&P 500 was the better choice here. But most recently it is looking pretty interesting for Enbridge. So could this be the perfect time to buy Enbridge stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. Starting off with revenue growth. For the revenue growth, I'm filling in 2, 4 and 6%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm putting in 13, 14 and 15. For the free cash flow margin, I'm putting in 20, 22 and 24. For the PE ratio, I'm putting in 12, 14 and 16. For the price to free cash flow, I'm putting in the same numbers. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Enbridge stock is around $41. I hit analyze, and we see a lot of red numbers. We have a low price target of $19 to $30. We have a mid price target of $26 to $40, and we have a high price target of $34 to $55. And to me, the mid price target is the most justified here, indicating this stock is fairly valued based on the discounted cash flow value. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Enbridge is that it could be a great dividend income stock. However, it comes with a risk. This industry in general is a bit more risky to me. Most fundamentals look pretty decent, but I personally prefer a bit more steadier business or industry. Revenue that is being a roller coaster and also high debt levels without any cash to support it is something that I tend to avoid. But again, from a dividend point of view, I do get the excitement. The only downside that I find is the decreasing dividend for 2 years in a row now. That's not a good sign. From a value point of view, it is also not looking that exciting. They are fairly valued based on the mid-discounted cash flow price target, but that's all. So for now, I'm skipping this stock, but I will keep analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.